I'm Piers Linney and this is Scale Up. I'm going through the 5 key factors that you need to consider if you're thinking of growing your business. The first one was planning. You need to have a plan. The second one was operations and execution. You need to put systems and processes in place and get your machine ready for growth before you need it. Thirdly was people. Your team is critical to your success. And the fourth video, this video, is about finance. And this is a subject I spend the most time talking to founders and scale-up management teams about. Unless your business is profitable and it's generating sufficient cash to fund your growth aspirations, you're going to need to raise money. That might be debt, that might be equity. And the key is understanding how you go about that, how you prepare to raise finance, and what your options are. So let's get into it. I'm going through the 5 key factors you need to consider when you're thinking of growing your business. If that sounds of interest, please subscribe and hit that like button. I've got a background in corporate finance. I was a corporate finance lawyer and I was an investment banker at Credit Suisse in the city, or Wall Street if you're American, for quite a few years. So I understand the complexities of financing. And it's very different when you're trying to raise money for a startup business or a scale-up company, a company that has customers and stakeholders and revenues. And the complexity, whether it's debt, whether it's equity, is enormous. And what I'm going to try and cover here are some key points to consider when you're thinking about raising finance for a business. So the first point to consider when you're thinking of raising money to grow your business, to fund that growth, is planning. You need to plan to raise finance. And people forget this sometimes. They leave it until the last minute and they've got a growth opportunity, whatever that might be, and they realize they need finance. And then they suddenly are rushing around to raise that finance. And raising finance can take anything from a couple of weeks to over a year. It depends what kind of finance you're doing, whether you're looking to do an IPO or whether it's additional finance on your overdraft. The timetable can be very, very different. So you need a plan to think about raising finance. And if you look at my 5 key factors about how you grow or scale up your business, each one of them, whether it's people, operations, the plan, financing or technology, all of these things come together. They're all things you need to consider when you're thinking of raising finance. When you're raising finance, the investor, whether it's a lender or especially an equity investor, they're going to do due diligence and they're going to look through each of these things and many more things. They're going to conduct financial due diligence, legal due diligence, commercial due diligence, to make sure that what they're getting into is what they thought they were getting into. And you need to be able to explain to those new stakeholders or the equity investors or your lender what your business plan is, how you intend to repay the debt and the interest, if that's the plan, or how you intend to create a return for equity investors. Equity investors, people who invest in return for shares, they need an exit. Now you might be planning to make enormous profits and pay them dividends, and that's how they receive a yield and a return. But often, especially in sort of high growth businesses, investors are looking for you to sell the business in the future or float it on a stock market, and that's how they get their return. That's called an exit or liquidity event. One of the issues that comes up quite often in terms of small, medium-sized businesses raising finance, and this is more of an issue, maybe a cultural issue in the UK than in the US, is the reluctance of these companies to take on board and bring on side or bring onto their board literally is new stakeholders. So if you're a lender, you may have new reporting obligations. If you're raising money from equity investors, you may have reporting obligations, like for example, monthly management accounts, but you may have a new person sitting on your board, or you may be giving somebody the right to place somebody on your board, perhaps even your chairman. And the point is this, is that if you want to grow and if your business profits are not sufficient to fund that growth ambition, you're going to have to raise finance. Now, whether you can raise debt finance or equity finance depends very much on your business, on its cash flows, on its asset base, where you are in your sort of growth cycle, the growth opportunity, the potential, and the probability of executing that efficiently. So to raise new finance, you have to enter into a contractual arrangement. And it's the contractual arrangement which governs that financing relationship, and also what control they may have over your business, what information rights they may have, what special rights they may have in terms of if they're a shareholder, preferential return rights, veto rights, consent rights. So it's a contract, and contracts are about balancing the cost and the benefit and coming to an agreement which you think it works for you and your business, and also for the new stakeholder, the lender or the equity investor. And if you don't like the contract, if there's something in there that doesn't work for you, then you need to think very long and hard about entering it. Don't just raise finance because you can, because you may find very quickly that you don't own your business. One thing I've learned about raising finance is, and this is more sort of mature businesses, is that, if it's something you don't understand, you don't have experiences, is go and find the best advisor you can possibly afford. Be that the financial advisor, be that somebody, an introducer, a middleman, they can help you find investors, be it your lawyer. Get the best advice you can possibly afford, because that contract, that document that sort of dictates your obligations and how you have to repay all the interest, or how your equity structure works and how the preferential rights work, or consent rights or veto rights, can be very, very complicated. And you need to understand it and make sure that when you sign on the dotted line, you know exactly what it is you're getting into. Now, to keep this video less than 2 hours long, I can't go through every single possible type of debt or equity financing. And what it's important for you to understand is what your options are. One frustrating thing about raising finance is that when you don't need the money, everybody wants to give you money. If you're growing quickly, you're profitable, you've got a fantastic plan, you've got intellectual property, everybody wants to provide you with finance. If you're struggling, or it's a turnaround situation, or you've got a new growth opportunity that's not particularly clear, it's harder to raise finance. So in most growth businesses, you are trying to finance the growth, sales and marketing, or new product development. But in many small and medium-sized businesses looking to grow, it's about funding working capital. I've seen many businesses where they've overtraded, where they've taken a massive order, they've got a shipment coming in from China, and all their cash is locked up in stock. And if that stock can't be released as quickly as they expected it to in terms of sales, then they can have a cash flow crisis which can kill the business. So if you realize you want to raise finance for whatever reason, you need to have a plan to raise the finance, but start early. It can take you several weeks if you're extending an existing bank facility, to even a couple of years if you're looking to IPO. If you're looking to raise money for mergers and acquisitions, to buy a company, be it vertical integration or a competitor, that can become very complicated. So the investors are looking at your business, but also the business you want to acquire, and maybe other business you're looking to acquire as well. So that becomes extremely complicated, which means it takes more time, more professional fees. So if it's M&A, think long and hard about when you start the fundraising process and take those investors on that journey. An equity fundraising process, from the day you're investor ready, you've got your business plan, your financial model, your term sheet, all the documentation you need to close that financing, it can take you 3 to 9 months to close that financing. So be ready for that. From research I've been involved in the UK, half of businesses, some of these small and medium-sized businesses, that they want to grow, they've got ambitions to grow, but a third of those businesses don't know how to grow. And typically the biggest issue is financing. How do they raise money? How do they raise these new forms of money, like crowdfunding or peer-to-peer lending? They don't understand the options. And quite often the people advising them don't understand the options either, because the world's moved on since the time that they trained and they learnt about the financing options in the market. And what often happens is this: so you're looking to raise money, you go and talk to your accountant. Your accountant's been doing what they do for many years, I'm sure they're very good at it, but they kind of know what they know, and they kind of know the old world. So you trot down the high street, you go and talk to a couple of the big high street lenders, they put the data into a computer, the computer says no, and that's the end of it. And this is quite common. More research shows this, that a load of companies, they go and talk to the bank says no, and that's the end of their financing process. There's a lot more to it than that. There are many options that you need to understand. And if your advisors, or the people around you, or the people even on your board or in your business, or your financial controller, if they don't understand the way the market's structured now and the different financing options are out there, you need to go and look elsewhere or change them. Now, since the credit crisis in 2007-8, the gap in the middle for many businesses, in terms of the gap between being able to raise debt and equity, has widened. And in many cases, that was a good thing, because lots of banks were playing in sort of equity risk and they didn't really know what they were doing, which is why they got into trouble. Now, there's still a gap there for in many ways, especially more so in the UK, between sort of seed finance and Series A. There's less growth capital. But over time, you're seeing that market imperfection be corrected. So there's more and more money out there, and there's more and more types of finance, and there's more innovation in finance. All investors want to do is put the mountains of money out there to work and earn a return. Now, if it's debt, they might be looking at a return in terms of interest, clearly getting their money back. And the way they protect their downside is very much by looking at your cash flows or assets. Sometimes you may be asked to give a personal guarantee. And that's something you need to think long and hard about, because if your personal guarantee is, say it's £25,000 and your personal assets are £1 million if you sold your house, then you can probably still sleep at night. If you're asked to give a personal guarantee of a couple of £100,000 and your personal assets are much more than that, then you can find yourself very quickly in a very sticky situation. So think very long and hard about what's called piercing that corporate veil in terms of moving outside of the limited liability you typically have in your company by guaranteeing its obligations. So if you're trying to raise debt, there's no point kidding yourself. What they're really looking for simplistically is robust cash flows that can pay the interest and maybe pay down the debt over time, depending on how it's structured, how it's amortized. And that might be a straight line. You might have a repayment holiday and you pay more at the end. It can be structured in many different ways. If you haven't got the cash flows, then typically they won't lend. But they might lend if you can show that there's asset backing. So take your mortgage at home, for example. What they're looking for is cash flow, that's your income, and asset backing, that's the value of the asset, your home. You'll pay a deposit, which is say, 25, 50%. There'll be a loan of the 70 to 50% on the other side. And in the worst case scenario, if they have to sell that property, they can repay the loan. It's no different in business. They're looking for cash flows and asset backing, and the mix between the two will depend on what kind of debt you can raise. Now, there's kind of debt in the middle of debt and equity, which is venture debt. They'll be looking for a higher return, they're taking more risk, and they may be looking for a piece of your company in the terms of shares or warrants or some other structure like that. So on the debt side, people are looking at ways in which you can leverage your assets. Now, asset might be intellectual property, that's becoming a much bigger part of corporate balance sheets these days, or credit card income. If you can see a track record of credit card income, you can finance that. It's a bit like factoring. But with that or factoring, you have to be very careful about how deep you get into it, because it's very hard sometimes to catch up that working capital and get back out of it if you ever need to. There's new types of debt finance. You don't have to rely on the high streets anymore. There's challenger banks. They're trying to compete with the existing banks and be more innovative and maybe use insurance or loan guarantee schemes so they can get over any credit issues your company might have. There's peer-to-peer lenders where they're putting together people who want to lend money to SMEs and growth businesses and the businesses that want it, and they're sort of matchmaking in the middle, and that's an enormous market. They'll do their homework, they'll look at the credit, they'll look at your cash flows, they'll look at your asset, and they may even ask for personal guarantees. And on the equity side, the world's changed dramatically. Now, it depends whether you're trying to grow your business from 50k a year to 500k a year, or 500 to 5 million, or 5 million to 50 million, in terms of what kind of equity you may be looking at. If you're smaller and you're a startup, it's friends and family, and it's your angel network. If you're even a reasonable sized business, you may be looking at angel networks to raise a couple of 100,000, maybe up to 1 million. There's now crowdfunding, and in the UK and the US especially, there's some very well developed crowdfunding platforms, and they're raising millions of pounds for businesses. But those processes take time, they take money, they take focus, you need a plan, you have to be able to survive due diligence, and you also end up having quite a large number of shareholders. Even if it comes through one vehicle, so you have one shareholder representing them, you still have to report to those shareholders over time, so be ready for that. Then of course there's venture capital. If your business isn't quite ready to raise private equity, it hasn't got the cash flows, or it's not quite a mature business, and there's still a lot of sort of equity risk in that business, the venture market is where a lot of money is raised these days. Now there's more of it in the US, especially growth capital in the UK, but we're seeing in the UK lots of new funds appear on the scene, regional funds that have been supported by the government to make finance available, and supported by the banks actually, to make finance available for growth businesses. What you'll find in the US is that seed rounds, Series A rounds can be quite a bit larger than they are in the UK. So don't be confused when you hear about a £10 million seed round or Series A round in the US. In the UK, you'll find that a Series A round is usually a couple of million. Now with the crowd, it can be quite different. You can focus more on the story and the PR, but it has to be credible. In venture, you're dealing with expert investors who you're negotiating with one-on-one sometimes in terms of who's managing that process. And that can require a lot of work, time and effort. And you need to be ready. You need to have the plan in place, have the model, have your go-to-market, have your team. and they will do their homework on your business across the board, be it legal, be it commercial, be it external commercial due diligence and research, or be it financial. Then if your business is more mature, there's private equity. Now, private equity, normally they'll take control, there'll be a controlling stake. They're looking for mature businesses with a proven track record. They clearly want a growth strategy, but they can also augment their returns by using financial engineering. So they may use debt. So for example, if you buy a house for mostly debt and the value goes up, you make more money because you put a little bit of equity in and you've made that much money out of that piece of equity. If you put in more equity, then the return compared to what you made at the end is a lot smaller. Now in financial engineering, the term you often use in private equity, they'll try and use debt to buy the business and hope it grows. So in the same way, it magnifies their return. On the other side of the equation, if the business doesn't perform, it can become very complicated, very sticky very quickly. The key to raising finance is clearly understanding that you need to raise finance and as early as possible, having a plan to raise that finance and preparing your business to raise finance. There's no point trying to raise finance and have regimented reporting obligations if your business is not set up to report on a frequent, accurate basis. You need to put this stuff in place. Look at my video number 2 about operations. It's about having these things in place before you try and raise finance. If your business records all over the place and you won't survive a due diligence process, sort them out, tidy it up, get them online, make it easy. You need to reduce as much friction as possible as there is for an investor to make a decision, to invest in your business, to go through the due diligence and then sign on the dotted line. Now, there's a huge amount of money out there. It's a question of matching up your business with the right kind of money. No point talking to private equity funds if you're a reasonably early stage company needs equity investment and can't support debt. So if you've got a growth business where you've got a plan, you've got a great team, you've got an operational plan, you've got a growth opportunity, you know what you're doing, you can tell a story, you can show an investor how they can generate a return, whether it's interest or whether it's an equity return on an investment in your business, then it's a buyer's market. Then of course is raising equity by way of an IPO. So listing your shares in the public market in return for new investment. Now that's probably something I'll cover in another video, but that is a real option. And there are lots of junior markets wherever you are in the world where there's less regulation, it can be easier to raise money, but be careful, especially outside the US, of liquidity in those markets. If you're considering an IPO now or in the future, then start to find the right advisors and talk to people about who needs to advise you to go through that process, because that requires an even probably 18 months of work to make sure you're ready to raise the money. And the money raising part can take place in the last few days. So you might do 18 months of work and find out in the last week you're not quite ready or the market's changed. So the more prep you do, the better. What you may find, and this is very much the case in the UK, I'm not sure about the US, but I'm sure there's similar pots of cash, is there'll be regional pots of money. You don't have to go and look at large angel networks or venture or going out there into the market. You'll find that in your locality you may have municipal or council pots of cash, or regional funds that are put in place by the government or other institutions. The idea there is to support business in a local area, and usually what they're looking to is to increase employment. Now, these may not be as sort of institutionally savvy as the large funds, but you can find that there's lots of cash that is focused on investing in local businesses. There's also grants as well, but don't think that grants are the easy option. It can take you just as long to secure a grant as it can to raise equity finance. Make sure you understand the tax breaks and the tax benefits in your country. So in the UK, for example, investors get a tax rebate on their UK income tax paid called SEAS or EAS, especially EAS for growth companies. Also R&D tax credits. If you're investing in R&D or innovation, you can actually claim back money from the government. It's hard cash you get in a couple of months, and it's a pretty easy calculation to work it out. So make sure you understand not just how you can raise finance, which means taking on new obligations, be it debt or equity or grants. Have a look at your sort of structure in your country about how the government is trying to support innovation, how much money you can claim back. The money is out there for growth businesses, whether you're a fast-growing startup or a family business that's been going for 100 years and now the next generation is looking at growing that business in new ways or in new territories, then the money's out there. Do not be afraid to go and look for it. So to summarize finance, really, it's about you need to make sure you understand when you need to raise finance and start the process early. You need to have a plan. Do your homework on the options, what's available, and then look at the options, look at your business and your business needs, and try and match the right finance for your business so that you're not wasting time and resource and energy and money chasing after finance isn't suitable. So that was video number 4 in my 5 key factors you need to consider when you're thinking of growing your business. My last video, video number 5, is on something which pervades all of them really, but which is increasingly important to success: technology.